Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at Applied Digital.
If you find our talks useful, please consider subscribe, like, and comment underneath, right? So let's just get straight into it because right now, the world's most brilliant artificial intelligence algorithms are racing toward, well, basically a massive, immovable, physical brick wall.
Yeah, the physical infrastructure bottleneck.
Right.
It is the defining constraint of the next decade, honestly.
Exactly, because it really doesn't matter how incredibly smart the software gets, right? Or how many billions of dollars are poured into training these models if there is literally nowhere left on the power grid to plug them in.
Right. I mean, we're talking about raw power, advanced cooling, and just sheer physical space.
Yeah.
The companies controlling that infrastructure they're essentially the gatekeepers to the future of technology.
So true. And today, we are not looking at another software company trying to build a better chatbot. We are looking at that physical bottleneck. So our goal today is to help you figure out if Applied Digital is the premier wealth-building opportunity for this whole computing supercycle.
And to really understand what they're selling, you have to look at their evolution. I mean, They actually have this heritage in crypto mining.
Which I know, this sounds like a completely different universe.
It does. But they've completely pivoted. They are now a pure-play AI infrastructure landlord.
Right, a landlord. People always use that old analogy, selling pickaxes during a gold rush. But I feel like that doesn't really capture the scale of what's happening here. Like the pickaxes in this scenario are the actual servers and the highly advanced GPUs. Applied Digital isn't selling you the hardware at all.
No, exactly. They don't sell the hardware.
They are the ones leasing the high-tech real estate and providing that massive industrial-scale electricity required to actually turn those servers on.
And that position in the value chain is incredibly strategic for them. Because think about it. When you buy and operate the servers yourself, you are taking on massive technology obsolescence risk.
Right, because chips evolve so fast.
Unbelievably fast. A new generation of GPUs comes out next year, and suddenly your multi-million-dollar server farm is outdated. It's losing its competitive edge.
Yeah.
But by not owning the servers, Applied Digital completely sidesteps that whole hardware trap.
Oh, wow. So they just monetize the raw energy capacity and the cooling systems, and the tenant brings their own hardware.
Precisely. They just provide the ultimate specialized plug-in.
Which actually brings up an interesting geographic point. When you think of cutting-edge AI, you think of, I don't know, Silicon Valley or maybe those massive tech corridors in Virginia. But their infrastructure-first strategy is heavily focused on geographically underdeveloped power hubs, specifically places like North Dakota. Why build the future of AI in North Dakota?
Well, it comes down to the brutal physics of data centers. These server farms generate an almost incomprehensible amount of heat. If you build a massive data center in a hot climate, a massive percentage of your power goes entirely toward mechanical cooling.
Like just running industrial air conditioners.
Exactly, just running AC units to keep the machines from physically melting. And that energy isn't doing any computation. It's just fighting the weather, which completely destroys your profit margins.
Oh, so North Dakota's climate is basically a giant free air conditioner.
Exactly that. The ambient temperature naturally offsets the heat generated by the servers. But even more critical is the power grid itself. Major tech hubs right now are experiencing multi-year wait times just to get connected to the electrical grid.
Right, multi-year?
Yeah, the power is simply tapped out. So by targeting regions like North Dakota, Applied Digital secures abundant, cheap, and immediately available power. That first-mover advantage creates a formidable competitive moat. Competitors literally cannot get the electricity they need to build rival facilities anytime soon.
That structural advantage makes a ton of sense. And I mean, we are seeing it translate into some truly explosive fundamental growth for them. The revenue inflection here is staggering.
It really is.
Like looking at the numbers in the fourth quarter of 2025, their revenue surged 98% year over year to $126.6 million, crushing Wall Street estimates. And then moving into the third quarter of 2026, it actually accelerated. Revenue hit $108.55 million, which is a 139.3% year-over-year increase. That is hypergrowth.
Oh, absolutely.
But okay, looking at those same financial reports, there's a number that stands out and seems entirely contradictory. They reported a 36-cent loss per share, which was worse than the 13-cent loss analysts were expecting. How does a company double its revenue but widen its losses on paper?
Yeah, so this is a classic trap for casual observers looking at high-growth infrastructure companies.
Yeah.
That 36-cent loss is a GAAP metric. generally accepted accounting principles. And while GAAP is important, in this specific case, it was heavily distorted by two massive non-cash items.
Okay, what were they?
One-time spin-off charges and very heavy stock-based compensation.
Ah, meaning they didn't actually lose that cash from their day-to-day operations. It's an accounting reality, but not a cash burn reality.
That is the crucial distinction, yes. To understand if their core business of leasing power is actually working, you have to look at adjusted EBITDA. That metric strips out the accounting noise and shows you the raw cash profitability of their operations.
And what does that look like?
The story completely flips. Adjusted EBITDA reached $20.2 million in that fourth quarter. That represents a very healthy 16% margin, and analysts were only expecting $4.16 million.
Wait, so they beat expectations by nearly 400%.
Operationally, yes, they obliterated expectations.
Yeah.
The core business is exceptionally profitable.
Okay, I follow the difference between the accounting loss and the operational cash flow. But wait, I'm looking at their balance sheet and I have to stop you there. Because the overall free cash flow for the quarter was deeply negative. We were talking about a negative $567.9 million.
A big number, yes.
And to fund this massive 500 megawatt build out they're doing, they are carrying a debt to equity ratio sitting between 1.65 and 1.79. You're praising their operational profitability, but I'm looking at a $500 million cash hole and rising debt. Isn't this an incredibly toxic setup for you, the listener, thinking about adding this to your portfolio?
I mean, it absolutely looks terrifying if you are analyzing them like a mature, steady-state retail business.
Right.
But you have to view infrastructure development through the lens of an S-curve.
Okay, let's break down that S-curve concept for someone who might not be familiar with it.
Sure. Think of it like constructing a massive state-of-the-art skyscraper. Before a single tenant can move in and pay you $1 of rent, you have to spend hundreds of millions of dollars acquiring the land, pouring the concrete, laying the steel, wiring the electrical systems.
Yeah.
During that construction phase, your cash flow is massively negative. Money is flying out the door and nothing is coming in. That is the steep ascent of the S-curve. But once the building is finished and the tenants move in,
the capital expenditures plummet, the rent checks start clearing, and your cash flow shoots through the roof.
Exactly. Applied Digital is currently pouring the concrete.
But the danger of building a skyscraper is that you finish it and nobody wants to lease it. Then you're left with an empty building and a mountain of debt.
Which is exactly what makes the next piece of data so transformative. They aren't building on speculation. They just secured a $7.5 billion 15-year lease agreement for their Delta Forge 1 campus.
Wow, $7.5 billion.
Yeah, and this is with an unnamed U.S. investment-grade hyperscaler.
When you say investment-grade hyperscaler, you're talking about one of the mega-cap tech giants, right? The companies with essentially unlimited balance sheets?
Yes, the absolute biggest players. And having a signed 15-year binding contract with a company like that completely reframes the debt profile. That 1.79 debt-to-equity ratio isn't a toxic liability anymore. It's leveraged growth.
Ah, I see.
When you have $7.5 billion in guaranteed future revenue from a tenant who will never default, the project becomes highly bankable. Traditional lenders look at that lease and will happily provide the capital needed to finish construction.
Because the cash flow is guaranteed. The tenant has already signed the lease before the roof is even on. And looking at the numbers, while they wait for that facility to come online, their current liquidity ratio sits between 2.38 and 4.82, meaning they have more than enough cash on hand to handle their short-term obligations. They aren't going to go bankrupt waiting for construction to finish.
Exactly. The financial risk profile has fundamentally shifted from speculative to secured.
And clearly, the institutional algorithms and the smart money notice that shift because the reaction in the stocks chart has been violent. Let's dig into the technicals a bit, because a $7.5 billion lease isn't just a number on a page. It creates a massive psychological shift in the market, and we can physically see that in the price action. On April 14th, 2026, the stock surged 9.6% intraday, hitting $30.25. But it's the structure of that move that really matters. It confirmed a bullish engulfing candlestick pattern. For you listening, a bullish engulfing pattern essentially means that the buying pressure on that day was so intense, it completely swallowed up the previous day's trading range. It's a visual representation of sellers completely exhausting themselves and aggressive buyers taking absolute control of the market.
And it wasn't just a temporary spike either. It broke through major structural resistance levels.
Right. It broke decisively above both the 200-day moving average, which was at 24.69, and the 100-day moving average at 29.27. Moving averages are basically the average cost basis of investors over the last few months or year. When a stock breaks above those lines, it means the vast majority of people holding the stock are suddenly profitable.
Right, which changes the psychology entirely.
Exactly. Psychologically, nobody wants to sell a winner that's breaking out, which dries up the selling pressure. The stock also successfully back-tested a major support band around $25, essentially pouring a new concrete floor right underneath the price.
Yeah, and the momentum indicators confirm that this is a sustainable shift, not just a one-day wonder. The Relative Strength Index, the RSI, moved right into the 50.79 range, indicating it has broken out of a sluggish, oversold phase and still has plenty of room to run before it gets overheated.
Nice.
But you know, the truly fascinating market mechanics are happening behind the scenes in the options market. Implied volatility spiked dramatically, up to 120%, driven by massive buying of high gamma call options.
Okay, let's explain that high gamma concept because it's a huge driver of why stocks sometimes explode upward seemingly out of nowhere.
Sure. So when institutional speculators buy a massive amount of call options, which are bets that the stock will go up, the market makers who sell those options are suddenly exposed to enormous risk. To protect themselves, those market makers have to go into the open market and buy the actual underlying stock.
Right.
Gamma simply measures how fast they have to hedge. With high gamma options, every dollar the stock goes up forces the market makers to buy more and more shares, which pushes the price up further, forcing them to buy even more. It creates a mechanical feedback loop that acts like rocket fuel for the stock price.
We're seeing that feedback loop specifically on the April 2026 call options with a $29 strike price. The math on those specific contracts projects that if the stock moves up just another 5%, those options could return a 73% gain.
Oh.
Yeah. That kind of asymmetric upside draws in even more speculative capital. But amidst all this institutional buying panic, I noticed a glaring contradiction. If this is the ultimate wealth-building setup backed by a $7.5 billion lease, why have company insiders, including the CEO, sold $9 million worth of their own shares over the last 90 days? As an investor, seeing the CEO cash out $9 million right when things are supposedly getting good usually sounds alarm bells.
I mean, that is a very valid concern.
Yeah.
And it's actually the exact reason why some automated rating services recently downgraded the stock to a strong sell.
Right.
Their algorithms saw the gap accounting loss we discussed earlier, combined it with insider selling, and automatically hit the panic button. But human context is vital here. $9 million sounds like a massive exit, but you have to evaluate against the size of the total holdings.
Right. Context is everything. How much skin in the game does the CEO actually have left?
A tremendous amount. The shares sold represent a very small fraction of his overall position. He still retains over 4.1 million shares. Insiders sell small portions of their equity for all sorts of reasons that have nothing to do with the health of the company, paying taxes, buying real estate, simple diversification. What is far more telling is what the institutional heavyweights are doing while those insiders trim their positions.
The institutions are backing up the truck.
They absolutely are. Institutional ownership is now incredibly deep. Voya Investment Management recently increased their position by over 400%, bringing their stake to $33.6 million. And HSBC just initiated a brand new position worth $29.5 million. These massive funds employ armies of analysts to scrub every detail of that 15-year lease. They wouldn't be throwing tens of millions of dollars at this stock if the insider selling was a genuine red flag.
And the broader analyst community is completely aligning with that institutional confidence. Following the announcement of the hyperscaler deal, Needham raised their price target to $48. Even the more conservative consensus has aggressive targets, from B. Riley hitting $53 and Northland projecting $56.
Yeah, the conviction from the street is palpable.
Mm-hmm.
But, you know, as with any investment, you cannot just look at the upside. You have to map out the horizon and understand exactly what could derail this thesis over the next 3 to 6 months.
Definitely. Let's talk about the bear case. With the institutional backing and the $7.5 billion contract secured, what is the actual risk?
The primary vulnerability is a concept called stranded capital.
Okay, we talked about the skyscraper analogy earlier. Stranded capital is what happens if construction stops halfway through, right?
Exactly. That massive $7.5 billion lease completely de-risks their deck, but only if they actually finish the facility and flip the switch on time. If their supply chain bottlenecks, say, a global shortage of industrial power transformers, and the commissioning timeline for the Delta Forge 1 campus slips by a year, they are in a precarious position.
Because the clock is ticking on their debt.
Right. The negative free cash flow continues, the interest payments on their debt compound, but the lease revenue hasn't started flowing yet. If that timeline slips, the leverage becomes a suffocating burden, and Wall Street will aggressively compress the stock's valuation.
So execution is the single most critical metric right now. They broke ground on Delta Forge 1 in early 2026, and operations are slated to begin in 2027. Any hint of delay is a massive red flag. So for you listening, what are the specific catalysts you need to watch for to ensure this thesis remains intact? The first major event will be their next earnings call.
And here's how you need to listen to that earnings call.
Yeah.
Do not panic about the EPS number.
Yep.
The actual earnings per share is a secondary metric right now because of that S-curve capital expenditure phase.
You aren't listening for profitability today. You are listening for proof that the timeline is secure.
Precisely. You want to hear management provide forward guidance regarding the Delta Forge 1 ramp-up. You want explicit confirmation that construction is hitting its milestones and remains on schedule. Beyond earnings, you also need to monitor the broader macroeconomic environment, specifically interest rates.
Because they are carrying debt to build these facilities, the cost of borrowing is a huge factor. If interest rates stabilize or get cut, that directly reduces their interest expense, which immediately widens their future profit margins. A lower rate environment acts as a massive tailwind for infrastructure landlords. But beyond the macro environment, there is a speculative catalyst hovering around this company that could completely change the valuation math.
Oh, this is perhaps the most exciting unknown for investors right now. There are credible rumors circulating that management is currently in advanced discussions with an entirely different, highly rated investment-grade customer.
Wait, really?
Yeah, for facilities across multiple regions.
So we're not just talking about the first $7.5 billion lease. They might be on the verge of signing a second mega lease in 2026.
Yes, and a second hyperscaler contract of that magnitude is absolutely not priced into the current valuation models for fiscal 2027. If they announce a second deal, it proves that their infrastructure mode, having the pre-secured power and cooling, is so valuable that the biggest tech companies in the world are waiting in line to sign multi-billion-dollar checks.
That would pour absolute gasoline on the stock's momentum. So let's pull all of these threads together and summarize the overarching wealth-building narrative here. Looking at the landscape, our final analysis gives Applied Digital a solid 8 out of 10 bullish setup. They aren't trying to outsmart the AI software developers. They have firmly positioned themselves at the physical energy bottleneck of the entire AI paradigm.
And their strategy of targeting underdeveloped, naturally cool regions like North Dakota has given them a massive first-mover advantage. The $7.5 billion lease validates that thesis entirely. We can clearly see the fundamental growth with revenues surging well over 100%, even if the near-term accounting losses make it look confusing on the surface.
But the key takeaway for you, the listener, is that this setup requires discipline and patience. This is not a quick flip. We are looking at a multi-year hold, specifically an 18 to 24-month horizon. The ultimate target is navigating through this heavy construction phase to reach the fiscal 2027 profitability inflection point. Current forecasts are projecting a positive 69 cents EPS by that time. When that cash flow finally turns positive and the skyscraper is fully leased out, that is when the true valuation upside unlocks. Applied Digital is establishing itself as the premier infrastructure landlord for the AI compute boom.
It really is a remarkable structural setup. As we wrap up this analysis, I want to leave you with one final thought to ponder off-air. We are rapidly entering an era where the sheer demand for AI computing power is going to wildly outpace the capabilities of the global energy grid. We're simply going to run out of electricity before we run out of ideas. 10 years from now, when power is the most heavily constrained resource on the planet, how unfathomably valuable will prime, pre-secured, climate-cooled infrastructure truly be?
That is the multi-billion-dollar question. Thanks for joining us today, and we'll catch you next time.